after the event, but I'm delighted to welcome Maria as our special guest today. Maria is one of our members, been a member for quite some time now. And I'm just doing some research into Maria's background and found that she's got an honours degree in astrology and cosmology, which must be reasonably unique. I don't come across astrologers and cosmologists very often. Cosmologists, Maria?
Cosmologists, and also astronomy, not astrology.
Astronomy. So
it's quite an important.
There's quite a difference, isn't it? I do apologise. Thank you for correcting me. How? Why?
It's kind of a little bit of a long story, but I can make it short. So at the time when I did my A-levels, I was going to do law as a degree, and I didn't quite get the grades to go to the right school. Did a year's law course while working for a hedge fund as a receptionist, hated law, decided to move into hedge funds from there. So I never actually got my degree at that point, but years later, I'd moved to Dublin. I'd been relatively successful in my career. I'd moved up quite quickly to be managing a team within like 4 years of being a receptionist. Tried to move back to London, and there were so many companies that just wouldn't interview me because I didn't have a degree, despite the fact of having years of experience doing the actual job they were looking for. So I decided I needed to do a degree, but I also wanted to do something interesting. There was no way I was going to be able to do it in my spare time, self-taught mostly. If it wasn't something interesting. And I'd always been fascinated I've watched tons of space documentaries and planetary science documentaries and Brian Cox and all of that. So it just seemed like the perfect choice. And I thoroughly enjoyed doing it. So much so I considered doing another degree at points, but my boyfriend tells me I'd be better off just reading a book rather than signing up for another degree.
Oh, fantastic. And when you look at planets and look into the sky, what's the thing that excites you most?
The planetary science side is incredible. The difference between all of our planets, the fact that Earth is positioned so uniquely in our solar system to bring out the conditions of life as we know it, kind of the search for life on other planets, which actually starts to seem more probable now on some of the moons of Saturn and Jupiter, although it will be kind of microbial, bacterial life, not civilization like we have here.
Okay.
And that side of it's amazing. The different types of stars and how they die and turn into different, like the magnetars, black holes, white dwarfs, etc. I could ramble on for ages about all of this.
Brilliant. It's fascinating. And the Americans relaunching lunar programs, is that exciting?
It is, I think. I mean, it's all supposed to be stepping stones to going human exploration to Mars, basically. Yeah. It's a lot more fuel efficient to launch from the moon to launch here. So, and the technology that comes out of it, even for Earth, I know a lot of people think money shouldn't be spent on space programs, but we wouldn't have things like MRI machines if NASA hadn't been doing work on space exploration.
Yeah. I'm lucky enough to be of the generation where I remember England winning the World Cup and staying up and watching those Apollo missions and man taking that first step on the moon, and it was inspirational as a young boy, actually. So I can understand your fascination with the subject. The other thing that you do for us is you're one of our CV reviewers for the Young Women's Trust, our nominated charity. Tell us about that work, and because I'm sure some others on the call might be interested in getting involved as well.
Sure. I mean, it was initially of interest to me because I'm quite passionate about kind of culture and diversity in the financial services industry. I do a lot of other things, and particularly at the SBAI, we do a lot of work on culture and diversity, which has been fascinating. So I wanted to find a way to volunteer, but as we all know, kind of time gets short, particularly as I have a job that involves a lot of traveling. It means I can't commit to necessarily to kind of regular in-person volunteering opportunities. So this came up and it seemed to be a good fit. There's some flexibility in it. So, you know, if I travel, I can rearrange my schedule. In fact, I've literally just been sent through my CV to review for this week. You can set up your own schedule. You can do one a month, one a week, once every 2 weeks, and you can alternate that when you need to. But it's amazing. It's really rewarding. There's a lot of incredible young women sending their CVs through on this that kind of makes you feel, I was gonna say bad, that's not quite the word. But there's a lot of the young women coming through this are from disadvantaged backgrounds, and they all want to do something that's helping someone. But like most of them want to go into non-for-profits, charitable organizations, mental health agencies, which I think is just incredible, and to be able to support them to do this. The other thing, and it's something that I'm quite vocal about when I see these posts on LinkedIn now, is it's made me very aware of some of the biases I used to have when I reviewed CVs.
Yeah.
You know, things like, oh, you know, if they haven't checked their spelling, you know, they're obviously not putting in the effort, etc., etc.
Yeah.
And then I read a note from a young woman that had basically said, you know, she's really sorry if there's errors in it. She can only snatch a few minutes at a time on a library computer to be able to do it. And it makes you realize that not everybody's lucky enough, like I was, to have a network of people that could review my CV or make changes. At least we're providing that service.
Maria, thank you. And I'm sure I know your work is really appreciated there. And if anyone else on the call wants to, or who may be watching this on catch up, wants to get involved, reach out to Katie. I think we're kicking off a new cohort of volunteers for the Young Women's Trust in a few weeks' time. So do get involved. Back to the order of the day. And thank you for that background into you. The Standards Board for Alternative Investments is where Maria works. She is the Research and Content Director there, and she's here today to talk to us about the implementation of different ESG strategies in alternative investments. Was that right, Maria? Right. Bang on. So I've got that bit right, which is good. Before you start, just tell us a little bit about the Standards Board for Alternative Investments, because I'm sure not everyone on the call is familiar with who they are and what they do.
Sure. So we are a global active alliance of over 155 asset managers and over 95 institutional investors in the alternative investment industry. And essentially our mission is to try and improve industry outcomes. We were formed in about 2008, just before the global financial crisis, actually, but by a group of hedge fund managers who recognized that if the industry didn't get its act together, then we were going to end up very heavily regulated. And while some regulation is good, excessive regulation can be detrimental to the industry and returns. So we put together our alternative investment standards, which all of our asset managers become signatories to, and they cover risk management, disclosure, fund governance, valuation, and shareholder conduct. And then outside of that, we run several working groups. So we have our responsible investment working group, we have a culture and diversity, and other strategy specific and regional specific ones. And these working groups bring asset managers and allocators together to discuss topical issues, produce best practice guidance. We publish all this best practice guidance on our website in our toolbox, and it's all publicly available to the industry. We figure we can't help improve the industry outcomes if we don't let the industry read our guidance. So it's all publicly available. And then on top of that, we engage frequently with regulators, respond to regulatory consultations, and we run a global event series for our members. So I've been there for 2 years. My role is, it's pretty self-explanatory, research and content. So I produce all of our toolbox content. I run all of our working groups. I run a program for small and emerging managers, run our culture and diversity initiative. And so that's us.
Maria, thank you. So let's get on with the order of the day then. Do you want to share the presentation at your end and drive it, or do you want us to?
Yeah, it's probably easier if I share it,
okay,
rather than saying next slide the whole time.
All right, brilliant. Then I'm going to pass over to you. I think, as usual, your up to being interrupted or being questioned as we go through these slides. Just a warning ahead of time that there is quite a lot of detail in here because it's a detailed subject. So do ask questions, do get involved. I'll certainly try to myself. But Maria, over to you. Over to you.
Sure, and I'm going to do this more as, I guess, like a guided conversation rather than a presentation. So I'll pause after every section in case people have any thoughts, comments, questions, or want to discuss any part of it. But like Mark said, please feel free to interrupt. So this is kind of the agenda. I'm going to walk through kind of the building blocks of responsible investment approaches or ESG approaches, and you'll hear me use those two interchangeably in the presentation, but it all kind of means the same thing. And then take a look at the different approaches and how different asset classes and strategy considerations impact the implementation. A little bit on responsible corporate and market citizenship, and a little bit on governance, disclosure, and documentation. We already did the about the SBI bit, so I'll skip through that bit quite quickly. You can feel free to ask for this presentation afterwards. We're happy for it to be shared. Okay, so if I start on we can now dive into it, I guess. So I think what's really important is to put thought into how you're going to approach responsible investment. There's a lot of different ways you can do this, and each type of approach has different considerations for things such as resources and data. You'll need to consider whether you've got the right resources in place for your planned approach, and that's both in terms of headcount and expertise, and also assess how you're going to get the required data, and that differs a lot between different asset classes, and I'll talk about that briefly in a moment. Is it available through vendors? Are you going to need to source it directly, which involves more resources? And also taking a look at whether the approach that you're going to take will actually have an impact on alpha, or a potential impact on alpha, and talk to your investors about that. So on the right-hand side here, we talk a bit about the different type of approaches. So we have responsible integration, and we've defined that as using ESG factors as part of your investment process, but not predefining the investment universe based on them. Then we have, we have responsible asset selection. So using tools such as exclusions, inclusions, or impact funds. And this does predefine the investment universe based on ESG factors. Responsible asset ownership. So considering things such as engagement, voting, and activism. And this is an approach that can be used whether or not the product has a dedicated ESG focus. And then finally, responsible corporate and market citizenship. So how does your firm act with regards to ESG related factors? So I'll just pause there for a moment and see if anyone has any questions on this part of it.
I've got one. The impact on alpha. Needs to be considered with any approach. What kind of consideration? What kind of considerations come into that? And is there any metrics which show actually how ESG funds compare with non-ESG funds in terms of alpha?
So the types of considerations, they differ depending on whether you're launching a brand new ESG focused fund, in which case it's quite clear to investors that ESG factors will determine the investment decisions. Or if you're taking an existing product and then applying an ESG filter over it, in which case the investors may have come in not knowing there was going to be an ESG filter on it. There's lots of papers out there about whether ESG is outperforms or underperforms, and you can probably find just as many that say it outperforms as underperforms. But the conversation's become a bit more prevalent recently if you think of oil prices.
Yep.
So all of these funds that have excluded fossil fuels have missed out on this kind of oil rally and the performance that came with it. So it's kind of acknowledging there'll be situations like that. If you choose to exclude certain investments, then you could miss the alpha from them, but it's never going to be possible really to kind of quantify the impact on alpha. It's just considering what are the potential impacts and disclosing those.
Okay, thank you. Anybody else? Debbie, have you got, you're probably quite well informed on this.
I think the thing that I notice is so many people use ESG as a kind of catch-all, and obviously there's impact as well as sustainability, which all fits in within ESG. And I think I recently set up, so I'm on a committee for the Society of Trust and Estate Practitioners, and some of the lawyers on the committee still refer to ethical investment, which is quite, I think, an outdated term. And certainly in sort of investment education 20 years ago, it was kind of, you'd have an ethical pro filter, an ethical strip away filter, and that was how you do it. So the world of ESG seems to have come on leaps and bounds, but I find there's so much discrepancy in terms of terminology, and everyone just greenwashes all the time. So it's just kind of like, yeah, we've got a tick in the box that must make this an ESG fund. And I think a lot of what we try and do is try and dispel the myth and actually talk about why an impact investment is different to an ESG investment, etc. And I think there's a lot of miscommunication there, especially for firms that are greenwashing. So it'd be interesting to hear your thoughts on that.
Yeah, I mean, I think you're absolutely right. And so these approaches that we've laid out come from a document that's in our toolbox called the Responsible Investment Policy Framework. And it was for exactly that reason that we did this. And we split out what are the different approaches, because everybody says I run an ESG fund, and it's like, well, that's great. Well, what do you actually do? And try and drive the disclosures to be more about the specific strategy rather than more generalized. And actually, when we come on to talk about responsible integration in a minute, one of the things that we recommend is if these ESG factors are being considered in your investment process, but they're not significant as part of the investment decision, then you shouldn't really be calling it an ESG focused fund, because that's just risk management. You should be considering any financially material risk. And I think that's where a lot of people are coming up short now, and where we've seen the regulatory enforcement actions on that side of it. The ethical investing side is interesting because it is still present as part of exclusions, and it's much more faith-based organizations who have their exclusion lists for their sin stocks. But it's a very specific part of one approach to ESG rather than used to describe the whole thing.
Thanks, Mary.
Okay, so while they're talking about responsible integration then, so we've defined this as using E, S, or G factors as part of the investment process, but not predefining the investment universe. So that basically means they have no more priority than other risk factors. And as I just said, this means that we don't think asset managers or anyone should brand their products as having an ESG focus. But it is an approach that can be used for practically all asset classes and strategies. The main point of difference comes to the availability of data. So if we look at public equities and corporate debt in developed markets, these are the least challenging because many jurisdictions have either mandated or are in process of mandating issuer disclosure of RI-related information, albeit very climate focused. And holding direct equity or debt means you can have conversations with the issuers, but it's more relevant to developed markets, and emerging markets is still much more difficult and has a lack of standardized disclosures. Private equity and private debt should be relatively straightforward, but requires more resources. Commodities and sovereign related assets such as FX, sovereign debt, interest rates, securities, typically has information available via vendors. But again, for emerging markets or niche commodities, it could be more difficult. Where it gets a little bit more complex is for derivatives and other instruments that rely on complex structures that involve central counterparties such as structured credit or insurance-linked securities. For single stock derivatives, if the data is available for the equity, it should be available for the derivative. But where there's multiple counterparties, it's often very difficult to look through all those layers and have the right transparency. But there are some efforts in place to try and change this. And these data challenges, I mean, they're going to be there for every approach to RI, not just integration. They're just the main difference in integration. And I'll pause again there.
Going to ask a question again, Maria. So, so this is my knowledge of ESG showing up here. So ESG factors in commodities. If we're sort of talking pork bellies, for example, is that all about the animal welfare, organic, etc., etc.? And is that a great example, or is that a bloody stupid question?
No, I mean, pork belly, for example, is on a lot of the faith-based exclusion lists.
Okay.
But it very much depends on what your focus is. And I think this goes back to what Debbie said as well, that ESG is not one thing.
Yeah.
Your fund might be considering environmental factors. It might be considering social factors. It might be considering governance factors.
Okay, yeah.
So your environmental factors might include things such as, is the mining extraction of the commodity detrimental to the environment? But it could also, on the flip side, think about, or does that commodity actually go to help green technology or renewable energy? Social might look at, human rights, anti-slavery, what is the supply chain management, and governance is pretty similar on most things. So it can vary.
Okay, yeah, I understand. Okay, that's interesting. But then moving on, FX, and what kind of ESG factors do you consider with FX then?
So there's kind of two. It's ES and G really. So an example of an E factor, you're looking at the sovereign state when you look at FX, right? Because depending on which way you trade, you could be helping to push a currency to be stronger or weaker.
Yeah.
So for example, Brazil's a good example. There's a lot of investor pressure around deforestation of the Amazon rainforest. So that might be an environmental one. A social one could be something like China and some of the human rights abuses. Not that you can properly trade the Chinese currency, but
yeah, okay, it's a good example. Yeah, okay, all right, understand. Thank you. And so, anybody else? Let's move on.
Okay. So I'm going to talk a little bit about some strategy considerations, because these are important as well as asset classes. I'll talk about them at a very high level, and if anyone wants me to go into more detail on any of them, I'm happy to do so. So you have long versus short positions. If you look in the media recently, there's been a lot of debate about the use of short positions in ESG funds, and some very strong opinions on both sides. In our view, they can be an important tool in an ESG fund if they're used properly. Short positions can increase the cost of capital for a company, making it harder to operate. It can express negative views to the market on ESG related practices. But really, through our conversations in our working group, there's quite a variety of viewpoints, but there's two main ways that people have been looking at short positions, particularly in terms of exclusion lists. So there are investors taking what they call a purely ethical view. So they don't want to profit in any way from certain industries, and therefore any exclusions would apply both to long and short positions. But then there's other investors that take a view that they want to exclude on the long side, but they don't see a reason to exclude on the short side, given the implications of shorting that we've just discussed. And there's a bit of a side note. There's also a big debate playing out now in the media and behind closed doors around whether short positions should be netted against long positions when you're reporting carbon footprints for a portfolio. And again, there's some very, very strong views on both sides of this. So the way that we've kind of come down on this is it very much depends on whether you're trying to report on the risk associated with your carbon exposure. So for example, if governments introduced carbon taxes, or whether you're trying to report on real world emissions, where it becomes a bit trickier. I won't go into too much detail on it. We do have a detailed thought piece on our website about this if anyone's interested in exploring it a bit further. And then just briefly, time horizon. So how long you hold your investment. E and S factors are typically seen as more long to medium term. So if you're only holding your positions for hours or days, they're likely to be less financially material, but it can change very quickly. Concentration of the portfolio, the larger your position relative to the issuer, the more meaningful things like engagement can be. And then just consideration of whether the instruments you use for hedging your risk in your portfolio will be subject to the same ESG criteria or not. And again, I'll pause there.
Maria, I think that's so. Unless anyone's got any questions.
What is a particular strong view on long versus short? Why are people so opposed or so pro?
I think a lot of it comes down to there's a lot of allocators that have signed up to the Net Zero Asset Owners Alliance. And what this means is they're trying to transition their portfolio over a period of time to be lower carbon emissions. So if you report your long and shorts net, you could be seen to have a lower carbon footprint than another portfolio that doesn't do that. So the debate has been really around whether you should be allowed to do that. So the strong views are literally on either side. One that, like any type of exposure, you can net it, and the other's trying to look at the real world impact. But then you can go down a rabbit hole and dive into, if you're shorting a position, someone has to buy it. And I won't go too technical there. But I'd suggest just if you Google short positions and carbon footprinting, you'll see Financial Times has recently done a lot of articles about it, and it talks about kind of the different viewpoints that are out there and who has it. And it's actually mainly a US versus Europe viewpoint, actually. More in the US are supportive of netting, and more in Europe are supporting of not netting the positions. I hope that answered your question in a very friendly.
Yeah, great, thanks.
Okay, so I will skip on to exclusions and inclusions, and this is where we are predefining the investment universe based on ESG factors. And this historically was really the main approach to ESG. And while it does remain in place for some investors, and it is possible with a lot of asset classes, we're starting to see more nuanced conversations around this, where divestment or exclusion becomes kind of a last resort, and people are really thinking about, if I just sell this asset, am I just giving it to someone who potentially cares less about what the outcome is, and perhaps other forms such as engagement might be more appropriate. I mean, I mentioned this briefly earlier, but the commodities point is also kind of important here, right? And it highlights the problem with exclusion. So on the surface, it's easy to say fossil fuels are bad or mining-based products are bad. But, the example I gave of mining, the mined product might be detrimental to the environment, but the actual product could then support renewable or green technology. But oil is another good example. If we all divest entirely from fossil fuels before there's a suitable alternative in place, then it's actually quite detrimental on the S side. So if you think about emerging markets, there's many of them that rely on fossil fuels for things such as hospitals and water sanitation, and don't have the technology to replace that just yet. So it needs a lot of careful thought, I think. In terms of inclusions, in credit now, there's a lot of new instruments that could be considered for this. So we have sustainability linked loans, sustainable bonds such as green, blue and social bonds, and transition bonds. But a lot of these are in their infancy and liquidity can be very low. And it's also really important to do proper due diligence on this rather than relying on the sustainable label. There's been a number of these that have been constructed quite poorly and don't really achieve what it sounds like they should achieve. And then lastly, I think on the exclusions and inclusions is derivatives, and it becomes very difficult to make a case that excluding a derivative asset has any real world impact. So it might be still appropriate for investors that are taking that ethical view that they don't want to profit from certain sectors, but perhaps not in any other approach. And again, I'll pause there.
Yeah, that makes sense to me. I'm not sure if anybody else has got a question. Donica, Umar, Funto, you welcome, by the way, three of you. Are there any questions? No.
No questions from me. Thanks.
Thank you. Okay, Maria, can move on.
I think she may have frozen, Mark, just judging
She
by.
has, hasn't she?
Over to you then.
I'm going to take this forward from here, guys. Maria, you're
Oh.
back with us. You froze for a while.
Okay. Sorry, I could hear you all. That's strange.
Okay.
Okay. Yeah, I mean, I think what I said is hopefully that the fact that there's no questions means I'm explaining it well. Rather
Yeah,
than...
you're doing. Yeah, absolutely, absolutely.
Okay, so I'll start again on impact then. It's impact investing. So this is investing with the specific goal of delivering meaningful and societal outcomes. And as I say here, for example, that might be reduction of carbon emissions, it might be supporting renewable technology, or quite often it's supporting the UN's social development goals. So it might be things around kind of clean water, human rights, that type of thing. But the important thing about impact that makes it different from just inclusion is this specific and measurable goal. And it's to achieve an outcome, and it needs to be measured. And there's a lot of difficulties in doing this. In general, this type of approach is really only effective in long equity, public or private equity, or private debt portfolios that have high portfolio concentration and low turnover. So basically, these are large investments into a company that are going to stay there for a while. And it's that type of financing that really helps these investee companies to be successful. That said, we are hearing now more impact funds being discussed in insurance-linked securities portfolios, focusing perhaps on underinsured communities, or there's some new types of catastrophe bonds that are out there that mean when a disaster happens, the insurance payouts happen much more quickly to actually allow the people impacted to recover rather than going through years of paperwork trying to get the reimbursement. I'm not going to go into too much detail on impact. It's quite a niche approach, I think. So I'll just pause to see if there's any questions.
I think that's explained well again, Maria.
Perfect. So we can move on to responsible asset ownership. So this is things like engagement, voting, activism, and this can be used kind of regardless of whether your portfolio has an ESG focus. And similar to other approaches, it's easier for some asset classes than others. Equity and debt investments, for example, are relatively straightforward. Equity comes with voting rights. You have direct access to issuers. I mean, strategy plays a certain impact here. Concentrated long portfolios that hold their positions for a long time have more opportunities for meaningful engagements. But an interesting example in engagement is actually sovereign assets. So sovereign debt affects interest rates. So sovereign states can be big, and typically the size of individual investments relative to the countries is going to be quite small, and that limits impact. But engagement can also have a potential political consideration here. So at what point does engagement become diplomacy or political intervention, given that sovereigns are accountable to their citizens rather than their investors? And so holding sovereign assets means you're not really an owner in the traditional sense, and you might have more limited legal mechanisms to influence issuers. So this might mean using alternative methods such as non-governmental organizations, NGOs, lobbyists, policymakers. And that brings some important considerations in having controls in place. You need to be able to, when you're dealing with basically companies and individuals that either have access to or influence on foreign governments or policymakers, You want to make sure that you're not receiving material non-public information or giving the appearance of having undue influence on governmental policies for the benefit of your portfolio. So it's just something to watch there. Outside of those asset classes, it is more difficult, but you can engage through different channels such as industry organizations, exchanges, or regulators. And I'm going to pause there again.
Maria, that's really interesting. The actually sovereign debt example you gave there about actually governments report to their citizens, not their investors. Are there examples of where investors have had significant influence over governments? I guess in maybe smaller third world examples.
I mean, I think, Brazil, the one I mentioned earlier, is
Yeah.
actually a positive example. There was a massive open investor letter around deforestation that's had some impacts. There's actually a case that I think the US have just charged a hedge fund manager for manipulating foreign currency via trading to profit their option trading. There probably are examples. I imagine most of them don't get found because you're right. They're probably but yeah, I mean, the currency of a country is important, right? It impacts their imports, their exports. Countries will want people to buy their currency, so they will, even though they're accountable to citizens, there is opportunities for influence, and that's where you have to be very, very careful.
Okay, interesting. Anybody got any questions? Then we'll move on again.
Sure, well, we're nearly there. So this last one is responsible corporate and market citizenship. So it's about the firm rather than the portfolio. So it's not really impacted by any asset class or strategy. It's really about having good environmental, social, and governance policies in place. And in our toolbox memo, which is a responsible investment policy framework, and on our culture and diversity toolbox on our website, we've actually got loads of examples of things that you can put in place to satisfy these, and they're publicly available, so feel free to have a look. But some examples, so environmental measures might be working to reduce your carbon footprint, energy efficiency, recycling, etc. Social measures might be things such as inclusive recruitment policies and proper diversity policies, and then strong governance. I mean, this is just corporate governments having the right policies and procedures in place. But it also includes good behavior in the market and how you impact the market. And this is going to include policies for things like market abuse, material non-public information, insider trading, making sure you're monitoring for that, but also training and talking to your investment team about how they behave in the market. I'm going to pause there again quickly.
Good. Maria, in terms of this, so you're talking here about the alternative investment managers themselves.
Mm-hmm.
It is known to be a predominantly white, middle-class, male environment as an industry. Whilst there's a lot of focus on obviously in ESG investing, how much attention do the SBAI put to actually the commitments that these firms are making themselves to being good firms?
Sure. I mean, so, I've worked in this industry for 20 years, right? And not an awful lot has changed, or over 20 years, but I'm going to stop at 20.
Don't go until you're my age, all right? Turns you grey.
I think up until a few years ago, it was always the same thing, right? Everybody would meet around a round table. We'd all sit and say, this isn't good enough. We should do something. Everybody would go back to their day jobs and it would kind of be forgotten about. It's something that we focus on a lot at the SBAI. It's been one of our core priorities for this year. We have a culture and diversity working group that now I think has just over 100 individual representatives from both asset managers and allocators. It's so popular that I have to run it in 2 time zones. I have to do it in APAC Europe in the morning and Europe US in the afternoon. What we found is actually there's a lot of people that want to make a difference and genuinely want to make a difference, but people are really stuck on how do I do it?
Yeah.
And they were setting themselves this kind of big goal of I'm going to improve diversity. And then you kind of look at it and go, well, that's too big a goal. I'll just put that to the side until I can think about it more.
Yeah, it becomes difficult. Yeah.
Yeah, it is. And we've worked now with our working group to come up to simplify this and actually produce some practical guidance that says, here are some things you can actually do. They're small, but if you keep doing the small things, it will all add up.
Yeah.
There's definitely a lot of focus, and we've actually put together an industry organization forum. So I chair this forum, and we've pulled together 13 different industry organizations now, including like AMA and ILPA and the MFA and 100 Women in Finance and lots of others, so that we can all collaborate and all kind of push in the same direction and not duplicate each other's work. So I think we might see some real momentum in this industry this time, hopefully.
Okay. And Maria, if we can do anything with my Men for Inclusion hat on there on that side, don't hesitate to reach out and invite us in.
Yeah, we should definitely talk about that. We were just commenting the other day how we've managed to end up with a committee that's entirely female, which kind of defeats the point of
yeah, and you can't do it all by yourselves, okay? You've got to get the majority involved as well. So.
Exactly, and that's not a diverse group. It's all
yeah. Okay, interesting.
But there's lots more on our website about all this stuff, and I really encourage you guys to look at the practical guides that we've really pulled out things that worked for people and put them in kind of simple steps that you can take.
Okay, interesting.
I mean, the last slide, I'm not going to go into too much detail. It's you need a policy. It needs to be clear and detailed. It needs to be governed internally, and it needs to be disclosed to your investors. And again, our policy framework can take you through all of that. So that's pretty much it on the presentation.
Maria, thank you. Thank you very much for that. Debbie, and so Uma, am I pronouncing your name right?
Yes, that's right.
Uma.
Yes.
Yeah. Am I right, Uma? You're at Casterbridge Investments.
Yes, that's correct. Yes.
Yeah. Okay. Interesting. Obviously, Debbie and Uma, you're almost sort of, if you like, on the front line of this, working for investment firms. How is ESG affecting you on a daily basis?
So Octopus as a group is a B Corp, and I know from the event we did at Christie's, I remember saying that to a couple of the working groups I was in, and people said, what's a B Corp? And it's a movement where essentially you have to fill out a lot of information about the direction of travel of you as a business, what you do on a granular to a more corporate-wide element to do things for the good of the environment and also for the good of social policy, etc. And there's not that many financial services firms that are B Corps. It's more kind of, there was a B Corp week earlier in the year, and so you could go to a supermarket and have a B Corp aisle, which is, so it's a lot around sustainable food and drink produce, and that's how it's more in the psyche of people. But so our founders are very concerned about doing things for the environment. We're the largest investor in renewable energy, for example, in the UK and actually in Europe as well. So there's all that. But then I brought up the fact that, you know, as an organization, we're not diverse. So it's kind of like, well, great that some parts of the business are, but I'm quite surprised. I'd be surprised if we retain that B Corp with our current hiring policies, for example. So it's kind of, there's some really good things that Octopus do, and then there's some, and I don't think I've been really thanked for highlighting the lack of diversity. it was basically, oh, well, you go off and do stuff off your own back then. Great.
Yeah.
I was like,
Okay.
perfect. Thanks for that. What support network? And apparently I'm at the end of my 6-month mentorship program, and I've met my mentor once. It's things
Okay.
like that don't fit day to day with being a B Corp. So it's all well and good on paper, but I think the reality, and I suppose because we've gone from being a small firm to quite a large firm, I think some of the things have been missed along the way. So, but in terms of what our investors invest in, I think we invest in a lot of really businesses that will change the future, and with things like female health, for example, is quite big on our agenda, as well as the environment. The environment has been for a very long time, but I think more of the esoteric kind of companies that we're investing in have got really important messages and really do want to change the world for better social good as well, and more equality.
Brilliant. Thanks, Debbie. And Umar, at Casterbridge, and your role there?
Yeah. So I'm actually new to the whole financial services. ESG. I'm actually straight from university, and I just started working for Casterbridge as the research analyst and actually in the ESG space. And it's really interesting because what our clients actually are looking for at the moment, there's quite a lot of demand in terms of the S in sustainability in the ESG sector, which actually we have found a bit of a struggle in terms of finding funds and other financial products to actually meet for those clients. So it was really interesting to see, obviously, to hear from Maria Long to understand different type of strategies and investment sort of stuff. So yeah, it was definitely something that we're looking to do more research on. Brilliant.
Umar, welcome to the industry. We need people like you, more people like you in the industry. So welcome. And if you haven't been to our website as well, you'll see there's another side to the business called Men for Inclusion. And I guess that's something that might be of real interest to you to get involved in. Have a look and do reach out to us if you want further information.
Of course. Thanks.
Thank you. Maria, we're almost up in time-wise. Final words, final thoughts?
I think maybe just building off something that Umar just said, that actually ESG funds really have been E funds, right? Mostly.
Yeah.
G has always been in place, so corporate governance has always been assessed for equity investments, etc. But the S side of it has been largely ignored, I think, until the last couple of years. So I think it's going to be an interesting space to watch. I think there's a lot more people thinking about social funds. We're seeing like fund of funds for venture capital funds run by women being, and a lot of this stuff coming out. It will be mainly in impact funds, and impact is difficult, so it's going to be slow. But it's a space to watch, I think.